Welcome to our in-depth analysis. Today, we're really digging into the latest from BP, their second quarter and first half results for 2025.
That's right.
And this isn't just about the numbers, is it? It's about trying to understand what these figures, these strategic moves, actually mean for, well, one of the world's energy giants.
Exactly. Where are they headed? How are they handling this, really complex energy landscape?
Our mission, as always, is to cut through the corporate speak, get straight to the core insights.
Yep. We've gone through the official BP group results document for Q2 and H1 2025. It's pretty comprehensive, lays out their performance, their plans.
Right.
It's a chance to really understand the mechanics, the shifts they're making.
So get ready, because we're about to explore where BP is today and where they might be going. Okay, let's kick off with the big picture. Looking at their overall performance, how did BP actually do in Q2 and the first half of 2025? Was it smooth sailing or?
Well, it's interesting. The underlying replacement cost profit, that's their key metric, really, stripping out inventory effects. For the second quarter, it came in strong, $2.4 billion.
Okay, strong compared to what?
Well, significantly up from $1.4 billion in the first quarter. So a nice rebound there.
Right.
But it's still down from the $2.8 billion they posted in Q2 of 2024.
Okay. Year-on-year context is important, and the first half overall.
For the first half of 2025, that RC profit was $3.7 billion.
Yeah.
Compare that to $5.5 billion in the first half of 2024.
So Q2 showed improvement, but the first half overall was definitely tougher than last year.
Precisely. A challenging start to the year, but Q2 brought some positive momentum.
And did that momentum show up in their cash flow? Were they generating good cash?
Yeah, actually, operating cash flow in the second quarter was $6.3 billion.
$6.3 billion. That sounds pretty solid.
It is. It's about $3.4 billion higher than Q1. And that reflects those higher earnings we just talked about, plus a lower working capital build this time around.
Okay, so they're turning profits into cash effectively. Good sign.
Mm-hmm.
So with that cash, how's the balance sheet looking? What's the story with net debt?
Net debt, always a key one to watch. It actually reduced slightly in Q2, down to $26.0 billion from $27.0 billion at the end of Q1.
Okay, reduction is good. How do they manage that?
Mostly those stronger cash inflows from operations, plus some proceeds from selling off assets, divestments, that outweighed their cash outflows.
But there's always a but, isn't there?
Well, yeah. If you zoom out a bit, that $26 billion is still up compared to where they were a year ago. End of Q2 2024, it was $22.6 billion.
I see. So progress this quarter on debt, but the longer-term trend still shows higher debt than last year. Something to keep an eye on.
Definitely.
Now, Murray Auchincloss, the CEO, he described it as another strong quarter operationally and strategically. He flagged their plan, growing upstream, focusing downstream.
And maintaining reliability. Over 96% across both. That's operationally quite sound.
It sounds confident. Was it genuinely a strong half operationally?
I think so, yeah. Look, they brought 5 new major oil and gas projects on stream in the first half. That's significant.
5 new ones, okay.
And made 10 exploration discoveries just this year so far, including a really big one in Brazil, the Boomerang block.
Boomerang, tell me more.
Well, they hit an estimated 500-meter gross hydrocarbon column. That's huge vertically. High-quality reservoir, massive area, over 300 square kilometers.
Wow, that sounds like a potential game changer down the line.
It could be, absolutely. Even with potential development factors like CO2 levels to manage. It's a major find for their long-term position in Brazil.
Impressive. Beyond finding new stuff, what about efficiency, cost reductions?
Yeah, they're definitely focused there. Delivered another $0.9 billion in structural cost reductions in the first half.
So how much is that in total now?
That brings the total to $1.7 billion saved against their 2023 baseline. They're chipping away at it consistently.
Okay. So for you listening, this paints a picture, doesn't it? A company managing its finances, generating cash, paying down some debt, but also investing heavily, both in traditional oil and gas and, well, we'll get to the new energy stuff.
Right. And they're looking after shareholders, too. Announced a second quarter dividend, 8.32 cents per share. That's up 4%.
An increase, okay.
And another share buyback authorized. $750 million for Q2.
Yeah.
It's all part of that plan to return, 30-40% of operating cash flow over time.
Yeah.
Shows confidence.
Definitely signals confidence. Okay, let's drill down now into the segments. That's where you see the different parts of the strategy really playing out, right?
Absolutely.
Let's start with gas and low-carbon energy. Crucial segment for their transition story. How did it perform?
Performance was pretty good in Q2. Underlying RC profit came in at $1.5 billion.
Which is?
up from $1.0 billion in Q1 and also slightly up from $1.4 billion in Q2 last year.
Okay, what drove that improvement?
Mostly higher margin production coming online and what they call an average gas marketing and trading result. So solid, not spectacular on the trading side, but good production margins.
And the actual production volume, how did that look?
Reported production for the quarter was 782 million barrels of oil equivalent per day.
Yeah.
Now, that number is actually down 13% compared to Q2 last year.
13%. Why such a drop?
Mostly divestments. They sold assets in Egypt and Trinidad late last year, so those aren't contributing anymore.
Ah, right. So the underlying picture might be different.
Exactly. If you strip out those sales, the underlying production was only down 2.1%. Major project startups helped offset the natural decline in existing fields.
Okay, that distinction is really important. Underlying strength despite asset sales. Makes sense. What about strategic moves? Anything significant happening in this segment?
Oh, loads. On the gas side, they started up the Mento development in Trinidad and Tobago. First gas flowing there.
Good.
Signed some big new LNG supply deals, 1 million tons a year to Zhejiang in China for 10 years, about 0.7 million tons a year to A2A in Italy, longer term, 2027 to 2044.
Expanding that global LNG reach then.
Definitely. Plus, they gave the green light the final investment decision, FID, for more wells at the KGD6 block off India. And in Brazil, that huge gas power plant, GNA2, started operations. BP's the exclusive LNG supplier and owns about a third of it.
Right, GNA2. Largest in Latin America, isn't it?
That's the one. And they also sanctioned a new compression project at Shah Deniz in Azerbaijan. So, yeah, lots of gas activity.
Clearly reinforcing the gas part of the strategy. But what about the low carbon element? That's where things often get, well, interesting.
Very interesting here, yes. They're definitely shaping the portfolio. The new joint venture with JERA, called JERA Next BP, that officially formed in August. Big ambitions in offshore wind. 13 gigawatts potential net capacity.
Okay, big move in offshore wind.
And they got consent for their Mona offshore wind project in the UK. That's 1.5 gigawatts.
Yeah.
So progress there.
But I sense a but.
But they also agreed to sell their U.S. onshore wind business to LS Power. And they're planning to exit the Australian Renewable Energy Hub project.
Selling onshore wind, exiting a big renewables hub, what does that tell us?
Well, that's the key question, isn't it? What does this portfolio shuffling really signal about their low-carbon focus? It looks like they're becoming more selective.
Selective how? Focusing on specific technologies or regions.
It seems like it. Maybe doubling down on areas like offshore wind, where they feel they have a stronger competitive edge, perhaps leveraging their offshore oil and gas expertise.
Right.
And maybe stepping back from areas like U.S. onshore wind, or maybe that specific Australian project where the returns or the strategic fit just aren't stacking up for them anymore.
So less spreading bets, more focused big plays.
Potentially. It suggests a more pragmatic, maybe disciplined approach to low-carbon investment rather than just being in everything, prioritizing scale and profitability pathways.
Interesting. Okay, let's pivot then to the other big engine, oil production and operations. How did that segment fare?
Underlying RC profit, there was $2.3 billion in Q2.
Okay, and how does that compare?
That's down. Down from $2.9 billion in Q1 and down from $3.1 billion in Q2 last year.
Why the decline?
Mainly lower prices, lower realizations on the oil and gas they sold, plus higher depreciation costs hitting the bottom line, although that was partly offset by higher production volumes.
Ah, so despite lower profit, production was actually up.
Yes, exactly. Reported production was 1,518 barrels. That's up 2.5% compared to Q2 2024.
And underlying?
Underlying production also increased by 0.8%, mainly driven by strong performance from BPX, their U.S. onshore business, though some planned maintenance elsewhere offset some of that gain.
So still growing the core oil and gas output, that's key. Any other big project news or discoveries in this segment besides the Brazil one we already talked about?
Yeah, quite a bit. They signed deals to take a 35% stake and become operator in 2 blocks in the Caspian Sea. That includes the Karabakh oil field. Expands their presence there.
Right, Caspian's important for them.
Then there's Ezeli Energy, their joint venture in Angola. They started up the big Agogo Integrated West Hub project.
Okay, new production online.
And Israel also made another discovery, a gas discovery this time, Gajajera Il-1. Early estimates are pretty chunky, over 1 trillion cubic feet of gas, plus maybe 100 million barrels of condensate.
Another significant find.
Seems like it. And back in the Gulf of America, the Argos Southwest Extension project started up too. Expected to add about 20,000 barrels of oil equivalent per day peak production.
Okay, so plenty of activity keeping that oil and gas pipeline full.
No question. They're still investing heavily in delivering new production in their traditional core areas.
Right. Finally, let's look at customers and products. This is the downstream bit servos, Castrol, EV charging, all that. What's it out here?
This segment had a really strong quarter. Underlying RC profit was $1.5 billion.
$1.5 billion. How does that compare?
That's a massive jump from just $0.1 billion in Q1,
Yeah.
and also well up from $1.1 billion in Q2 last year.
Wow, what drove such a big improvement?
Mainly a much stronger result from the customer-facing businesses, and also a really strong contribution from their oil trading arm.
Okay. I heard Castrol did particularly well. Big brand for them.
Absolutely. Castrol's earnings in the first half were actually more than 20% higher than the first half of last year. Strong volumes, good margins, brands performing well.
Good to hear. Any strategic moves in this segment? Buying, selling, expanding?
Bit of everything. They sold their mobility and convenience business in the Netherlands, including the p.l.c. EV charging there, to a company called Cadem BV.
Okay, an exit.
But on the expansion side, particularly in EV charging in the U.S., they opened 3 big gigahubs near airports: L.A., Boston, San Francisco.
Gigahubs. Fast charging, presumably?
Yeah, ultra-fast charging. And they did that interesting deal with Waffle House.
Right. Waffle House partnership to put chargers there.
Exactly, leveraging those high-traffic roadside locations. Smart, potentially.
Interesting combo. Anything else?
They also announced a strategic review of the Castrol business itself, just looking at options there. And they plan to sell their mobility and convenience business in Austria, too.
So more portfolio, tidying up, focusing maybe.
Seems like it. Constantly tweaking the mix.
Okay. So for you, the listener, looking across these segments, gas and low carbon, oil production, customers and products, you really see BP juggling, don't you? Balancing the old and the new, investing here, divesting there. It's a complex machine.
Very much so. A multifaceted strategy in action.
Let's shift gears slightly to the financial framework and the outlook. What are the key financial guardrails BP has set for itself?
They're pretty clear. They want to maintain an A-grade credit rating. That's paramount.
Okay. And debt. We talked about the recent moves, but what's the target?
The target is to get net debt down into the $14–18 billion range by the end of 2027.
Right. That's a clear goal for the balance sheet, shows discipline.
It does.
And how much are they planning to spend to get there and fund everything else? Capital expenditure, CapEx?
They're sticking to their plans,
Yeah.
expecting around $14.5 billion in CapEx for this year, 2025.
And beyond.
The frame for 2026 and 2027 remains unchanged, too, around $13–15 billion per year. So disciplined spending levels.
Okay, consistent approach there. Now, something caught my eye, a change in how they measure refining margins. RMM to RIM. Can you unpack that?
Yes. That's quite a technical but important shift.
Yeah.
They've retired their old refining marker margin, the RMM.
Which was a kind of industry standard, wasn't it?
Broadly, yes. And they've replaced it with their own internal metric,
Mhm.
the BP refining indicator margin, or RIM.
Okay, RIM. Why the change?
They say the RIM reflects a wider range of crude oils they process
Yeah.
and the products they make. So they feel it's, more representative of their specific refining assets and the actual margin they capture per barrel.
More tailored to BP then.
Exactly. And it changes the sensitivity. The rule of thumb now is that a $1 per barrel change in this new RIM impacts their underlying pre-tax profit by about $550 million.
And the old RMM impact was?
It was $400 million for a $1 change. So the new metric shows a higher sensitivity.
Interesting. So for you listening, what does this shift really signify? Is it just about better transparency for investors, showing a more accurate picture? Or does it say something deeper about their refining operations?
That's the question, isn't it?
What do you think it signifies?
I think it's likely a combination of things. Partly, yes, transparency, giving investors a bespoke metric that, in theory, tracks their actual performance more closely than a generic marker.
Makes sense.
But it also perhaps signals confidence in their specific refining portfolio. They're saying, our system is unique, here's a tailored way to measure it, rather than relying on a broader, maybe less flattering benchmark. It allows them to tell their own story more precisely.
Okay, a move towards more bespoke reporting. Got it. Looking ahead then, what's the guidance for Q3? Anything specific to watch for?
For the third quarter, they expect reported upstream production oil and gas to be slightly lower than Q2.
Okay.
In the customer's business, they expect seasonally higher volumes.
Yeah.
That's pretty typical for Q3, summer driving season and all that.
Yeah.
And in products, the refining side, they expect significantly less planned maintenance, fewer turnarounds, That should generally be positive for profitability.
Any negatives?
Well, cash flow-wise, they expect income tax payments to be about $1 billion higher in Q3, mostly just timing of payments, not an operational thing per se, but it impacts cash out the door.
Okay, timing effect on tax. And for the full year 2025, what's the overall outlook?
For the full year, they're still guiding towards reported upstream production being lower than last year. Underlying upstream production also slightly lower compared to 2024.
Okay, production down slightly year on year.
Within that, oil production and operations basically flat underlying, but gas and low-carbon underlying production expected lower. They do expect continued growth in the customer businesses, helped by those cost cuts, and stronger underlying performance in the product segment overall for the year.
And financials, tax rate, divestments.
Underlying effective tax rate still expected around 40%. Divestment proceeds still targeted at $3-4 billion for the year, but they flagged most of what's left will likely come in Q4.
Right, back-end weighted.
And those Gulf of Mexico settlement payments, they expect about $1.2 billion pre-tax for the whole year. Most of that, $1.1 billion, was actually already paid in Q2.
Okay, so pulling it all together for you, our listener, it highlights BP's focus, doesn't it? Disciplined finances, that ongoing strategic pivot we talked about, but always with an eye on delivering returns back to shareholders.
That seems to be the balancing act.
Well, we have really taken a comprehensive deep dive today into BP's latest results, uncovered quite a few threads, strategic, financial,
Definitely.
from those, solid Q2 profits and strong cash flow to the project startups, the cost cuts.
Yeah.
It's clear they are actively trying to steer the ship.
It's definitely a complex picture, though. You see them balancing these big ongoing investments in oil and gas with this clear but maybe increasingly focused pivot towards low-carbon energy. And all of that is underpinned by trying to keep shareholders happy and the balance sheet strong. Looking at the details in each segment, you really see a company adapting or trying to adapt to this, well, incredibly dynamic global energy world.
Which brings us to a final thought, something for you to think about. BP talks about its 12-quarter plan. They're only 2 quarters into it now. What does this report, with all its detail, really tell us about the future path for companies like BP?
Yeah, can these traditional energy giants genuinely transform into what they call integrated energy companies?
Or will that reliance on hydrocarbons, which is still so evident in the numbers and projects, always define their core identity? After digging into all this, what stands out to you as the single biggest indicator, maybe, of their long-term direction? Something to ponder.